Assalamu alaikum. Welcome to lecture 2 of tax. Now we are going to go in depth to the various type of taxes, starting with income tax. So lecture 1 I have already uploaded. It's there on my YouTube channel under my tax playlist. So now starting with income tax computation. Here we are going to go through income tax computation. I'm going to introduce you to income tax, how it's calculated, the proforma. You have to learn all the proforma of various types of taxes. Okay, this will help you in your ATX as well. Then income. There are various types of income, and you have to know these types of income. Why? Because various types of income are taxed in different ways. Mainly there are three types of income divided into three categories: non-savings, savings, and dividend. Then we have exempt income, those income which are not taxable, they are not taxed. And income of married couples, personal allowance. Every individual who pays tax, they have some personal allowance. This is an amount on which you don't have to tax, and it's fixed for this tax year. So personal allowance, the basic rules of calculating personal allowance. Then under some circumstances when your personal allowance reduces, that we are going to study reduction of personal allowance. Then we are going to go to the calculation of income tax payable. You will be learning various tax rates and how the composition of taxable income. Then taxation of savings income. And for savings and dividend, there are special cases where we have a 0% rate for both savings and dividend. This is not for non-savings. Now, deduction from total income. So we are going to go through that. And qualifying loan interest. What is this qualifying loan interest? We are going to go through that. This are those interest on loan which you can deduct from your total income. That means it's good, it saves more tax. Then donations to charities. Any donation to charity have some special tax advantages. One is payroll giving, the other one is donations under gift aid scheme. Then because we are donating to charity, for that we can extend our basic and higher rate. For income, there are three categories: basic rate, higher rate, additional rate. Basic and higher rate we can extend further. That means more of your income will be taxed at basic and higher. If you are donating to charity, it's good if you are donating to charity. Then pension. Various types of pension. There are two types of pension: occupational and personal. What are the reliefs when you are paying into occupational pension scheme, and relief for contribution into personal pension scheme? And people with earnings not exceeding 3,600. Then annual allowance. Then tapered annual allowance. Annual allowance charge. Lifetime allowance. All this we are going to cover under pension. Then for married couples, how we are going to utilize personal allowance and basic rate band, how we can transfer the personal allowance among the spouses, gifts to charities, the high income child benefit charge, then basic income tax planning, tax-free investments, and finally we are going to conclude with the overall lecture and also on which part of the syllabus we have covered, and also what are the technical articles one needs to read. So here, this is an overview, visual presentation of what I've just covered. Okay. So the main objective of this lecture is what? To prepare a suitable format for income tax computation, and it's for individual. For companies, we have separate. Okay, for various types of income, taking care of all the available deductions and reliefs. Okay, so income tax pro forma you have to know, earned, unearned, exempt income you have to know, then income tax payable, the tax rate, savings income, special case and dividend income, then personal allowance, the basic rule and the amount, deductions from total income, qualifying loan interest. Then you donate to charity, payroll gift, gifted donation, extend basic and higher rate, and gifted and personal allowance. Pension, the types, personal schemes, and occupational scheme and additional matters. Then we have married couples utilizing their personal allowance, marriage allowance, tax-free investment, gift to charity, and high income child benefit charge. So let us start with this. So income tax. Okay, this is the most easiest and the widest area in your syllabus, both in ATX and tax. If you want to take ATX in your professional level, make sure that you are a pro in tax because it will help you. Okay, so income tax is one of the easiest, one of the highly scoring, and one of the area which is going to be highly tested in tax. Most of the marks are in your income tax. If you are good in income tax, you will understand other types of taxes that I'm going to cover later on. That is capital gain tax, corporation tax, inheritance tax, VAT. Everything follows later on. So income tax, I'm going to go a little bit slow. Okay. Now, income tax is a tax that is in a tax on the income of an individual for a certain tax year, given tax year. Okay. Now, what is taxable income? Taxable income is that income which is liable to income tax. Not all income are liable to income tax. That's why we have exempt income also. Okay. So from your total income, you deduct certain deductible amounts and then you charge tax. So mostly if you see in your exam, question says calculate tax liability. How do you do that? You need the tax rate, you need the allowances, okay, and this will be given to you in the exam, the tax rate and allowances. So do not worry. And the key to successfully crack this tax computation is follow a standardized computational approach. That is the proforma. You have to learn it and you have to apply it from each question to question. Next. So this is the proforma that I'm talking about. Once you crack this proforma, income tax computation is nothing. It is very easy. Divide your income into three categories vertically in columns: non-savings, savings, dividend, and total. Then we have non-savings. First we'll categorize the non-savings. If you are having any trade, any business, unincorporated of course. If it's incorporated, it comes under company income. It's not here. So unincorporated, any profit from unincorporated trade, that means a business of a sole trader, falls under non-savings. Then that non-savings you write in the total. Employment income is again non-savings. You write in the total. Pension income again non-savings goes in the total. Property income again non-savings goes into total. Remember, each of this type of income I'm going to follow later on in the lecture. There's a huge lecture on each type of income. For employment income, we have a separate lecture, pension income separate lecture, property income separate lecture, unincorporated trade separate lecture. Okay. There we are going to go in depth in detail. Just this is a basic pro forma. Then savings income under savings, then total. Dividend, dividend, and total. Usually savings and dividend we just have one. But non-savings is the area which we are going to focus more because it has various types of income. Then total income. Write the total. Then any reliefs, there is a note to it, I will cover in the next slide. You deduct from non-savings and total. Then net income. See, first total, this total, the name, you have to know it, you're going to get marks for it. Total income is not same as net income. Net income. In some cases, total income will be equal to net income if you don't have any reliefs to deduct from total income. Rare condition, okay? So total income is one thing, net income is another thing. Then we have personal allowance. Personal allowance is deducted from net income. There's a note to that also. Then you have your taxable income. So three things important: total income, net income, taxable income. They are not the same. Okay, taxable income from all the four types of income, three types of income. Then you apply the rate based on the level of your income. There's a table for it. And you get your income tax liability. From your liability, you deduct whatever the tax that was deducted as source. This is mostly for employees where their salary tax is deducted from their salary, then they are paid the salary. Okay, then the end result is income tax payable. Five things are important: total income, net income, taxable income, income tax liability, income tax payable. Any of this they might ask in the exam. So be careful what they're asking. They might not always ask you income tax bill. Sometimes they might ask you income tax liability. So do not deduct tax collected on source. Okay. Sometimes they might just ask you net income. So pay careful attention. Now coming to the notes. Remember the first note was under reliefs. So any reliefs or personal allowance, first you should set off against non-income, non-savings, then savings, then dividend. There is a reason for it because this is mostly from the point of tax is very efficient. You have to pay lesser tax. Then non-savings. So now this is a diagram for you to visualize your non-savings income. Non-savings income is divided into two: earned income, unearned income. Earned income are your employment income. Okay, there is a note to that. Then pension income, then trading profit, and property income from furnished holiday lettings in UK. Unearned income is also property income from furnished and unfurnished, but excluding furnished holiday lettings. Okay, it's only property income. Then, so earnings from employment are any salary or any benefit that you have received. Okay, cash equivalent values of, so cash equivalent values of taxable benefit. Like if you're having a company car, what is the cash equivalent of that company car? That that also we are going to study. Then taxable earning. Taxable earning is your gross amount less any allowable expenses of employment. When we go through employment income, we are going to go through that list. What are allowable, what are not allowed. What you can deduct, what you can't deduct. Next is, so tax generally collected at source for employees as well as for pension. Otherwise, self-assessment. Self-assessment means you pay the tax. Okay. Same for pension also. Next, trading profit. So this adjusted trading profit can arise from employment, okay, for sole trader and partnership. Now, adjusted profit. So accounting net profit, what you have calculated on an accrual basis or a cash basis for small business as adjusted for tax purpose. You have to adjust whatever the profit you have got from your balance sheet, you have to adjust for, sorry, from your income statement, you have to adjust for tax purpose. And all this type of taxes, trading profit, property income from unfurnished and furnished, are collected by self-assessment. Okay, so property income, gross rent minus allowable expense. Same for property income under unearned income. Now, non-savings. So there's a note to that. Okay, for employment income, you have to refer lecture 4, payee lecture 5, and self-assessment lecture 11. Lecture 6 for adjusting trading profit and cash basis for small business. Then, so non-savings has all the earned income, employment, trading, pension, and property. Now, savings, all the interest are savings income and dividend income. Here also we have the tax rate and they are collected by self-assessment, savings and dividend income. Then exempt income, it's a big list. Okay, so the main exempt income are, let's go through this. Any income from letting a room in the taxpayer's own home up to a certain level. We'll see lecture 3 for this, the next lecture. What is that limit level? So if you are letting your room to someone in your own home, any income from that is exempt up to a certain level. Certain investment income are exempt. We'll see in lecture 3. Certain employment income and benefit are exempt. We'll see lecture 4 and 5. Then any interest that you have received on the tax repayment from whichever, exempt. Any income from betting and gaming, exempt. Now, income of married couple. Each spouse are assessed separately for income tax. Husband income separate, wife income separate. You do not add them together. Okay. And if they have a jointly owned asset, we'll see what is their share appropriate share in that asset. Okay. Now, income arising from jointly owned asset will be split equally 50-50 unless they make a joint declaration to split their income based on their actual percentage. Okay. And how the married couple can reduce their exposure to income tax will be covered later in this lecture. Now, third area, personal allowance, very important. So personal allowance is an amount which taxpayer does not have to pay tax on, and it's fixed for a given tax year. Now, this personal allowance, as you have seen in the pro forma, is a deducted from net income. If the personal allowance exceeds your net income, remember your unused amount, that means the amount that you have not used as personal allowance, you cannot carry it forward to the next year, it's wasted. And the standard personal allowance you have to remember is 12,570 for 2024-25. That is your financial at 2024. Next, reduction of this. If the taxpayer's net income is more than 100,000, personal allowance starts reducing. How? It starts reducing at a rate of 1 for every 2. Then you have to calculate it, what is known as adjusted net income. What is adjusted net income? Your net income minus your gross pension contribution minus your gross gift aid donation if they give you in the exam. Let's say if a taxpayer has a net income of more than 125,140, your personal allowance is nil. Okay. So effect of this progressive reduction means if your net income is between 100,000 and 125,140, your income, your personal allowance will start falling off. Okay, you will suffer an effective marginal rate tax rate of 60%. Okay. Well, you don't have to know how it is 60%, but just remember it is at 60%. Now, so with such a high rate, it's always advisable that you make additional pension contributions or charitable donations if you are seeing your net income exceeding 100,000. The moment it starts exceeding 100,000, make additional pension contributions or charitable donations so that your net income does not exceed 100,000. Why? Because this pension contribution you will deduct from your total income. Okay, so that your net income falls below 100,000. Now let us do a question on this reduction of personal allowance. Activity 1. So here you have to calculate Mr. Brown's taxable income, assuming his net income for the tax year 24-25 is first 60,000, second 110, third 127. This is just the personal allowance, and in activity 2 we shall go through gift aid and personal allowance. If you are making gift aid, what is the impact on personal allowance? What is the right answer out of this 4 options A, B, C, D? So you have been given the net income where the payment of 800 net to a charity 118,900 is ignored. Okay, then what would be the taxable income? So let us first finish with A. The best way, this I have opened the blank workspace of the tax. Okay, so here the best way to do any calculation is spreadsheet. I've copy pasted the question here in the word processor and I'll be solving it in the spreadsheet. Activity 1. Okay, so since there are 3, you can simultaneously do them one after the other rather than completing one and then going to the second and then going to the third, which is time consuming. So here first scenario, second scenario, third scenario. Okay, now here so let me make this bold. Now so total income TI is equals to net income NI in this case. Since you don't have any reliefs to deduct from total income, whatever is your total income is equal to net income, which is 60, 110 and 127. So 60, 110 and 127. Now first we'll deduct personal allowance. Okay, so under first one you see your net income is 60,000, which is less than 100. You will get full personal allowance minus 12,570. Okay, here in the second one, this is 110. It's more than 100,000. So personal allowance will reduce here. How much? This minus 100,000. I'm going to put this in bracket. Divide by 2. 12,570 minus whatever is done in the bracket, that is the difference 110 minus 100, divide by 2, because that's how you get the reduction in personal allowance. Always the net income minus 100,000 divide by 2, and whatever the answer you get will be deducted from 12,570. So this is the personal allowance, 75,770. Just put a minus sign outside so that, okay, wait. This will be deducted from this. Okay, this is reduced personal allowance. If you want to make this minus, just multiply it by minus 1 so that the whole answer becomes negative. Again, I'm going to put a bracket into minus 1. You see, I've changed the positive to plus. All I did was I have put this whole thing inside the bracket and multiplied it by minus 1 so that the whole answer is multiplied by minus 1 and becomes negative. If you know any other way of converting plus to negative, you can apply. There is no harm in that. Then the last one, 127. Again, it's more than 100,000, but it is also more than 125,140. So immediately no need to do any calculation. It is 0. Just make a note saying it's more than 125,140. Therefore, personal allowance is 0. So now your taxable income. When you're making any answer, make sure that this is in bold so that your answer is highlighted. Okay. So all you need to do is just perform the sum function. Since this is already in minus, if you do minus, what happens is it will be added because minus minus. So just perform the sum function, drag it like this and enter. All you need to do is drag this to the other cell. The formula will be copied. So this is your taxable income. This is very effective, less time consuming, and can be done within a short span of time. You do it in one cell and copy paste in the other rather than doing it every time individually. Coming to activity 2. So you are making a gift aid donation. This is your net income, 118.90. You are making a gift aid donation, 800 net. Remember, you have to cross up your gift aid donation. The gross figure you have to add with the net income, not the net. So now we'll do that. Okay. So here, activity 2, your net income is 118,900. Then we have personal allowance. Personal allowance is 12,570. Then gift aid donation, gift aid donation. Gift or donation you have to gross up. Okay, you have to deduct that from net income. Gift aid donation. So net income is, just copy paste, and gift aid donation you have to gross up, equal to, it's 800 multiplied by, this is how you gross up, always multiply by 100 divided by 80, 1000. So 1000 is the net figure, gross figure. Just put a minus next to this. Okay, so now you need to calculate adjusted net income. That's why from net income you deduct your gross gift aid donation. Perform the sum function. Okay, once you get the sum function, then this is your adjusted net income, and your gift aid donation. No, you have to deduct your income, which is 100 minus 100,000. So just perform the sum function again. This you need to divide by 2. Okay, just put a minus next to it. Okay, now this amount will be deducted from this. That will be your personal allowance, new personal allowance. Just perform the sum function since already a minus figure is there. This one is. If you want to convert a plus to minus, just put a minus next to it. Now, so this amount, this is the new personal allowance, will be deducted from your net income, and you will get your taxable income. Just perform the sum function. From this net income, deduct this. Done. So this is your taxable income. For your ease, I have copy pasted this. I've taken a screenshot and copy pasted the question with the answer. So as you can see, activity 1 answer is there. So when you're taking the PDF slides from me, you will have this question answer pasted. Next, and also activity 2, where the correct answer is C. So now, calculation of income tax payable. So the rate of income tax not only change with the level of your taxable income, for example basic rate, higher rate, additional rate, but also according to your types of income. If it's dividend income versus if it's savings or non-savings. If it's dividend income, rates are different. If it's savings and non-savings income, rates are different. So this table you need to remember, and the rate did not change from the previous year. It remained the same. That is basic rate. That means your income from £1 to 37,700 is known as basic rate. Next slab, 37,701 to 125,140 is known as higher rate. Third, the largest category, one who is having the highest income, 125, 141 or more income, it is known as additional rate. The more income you have, the more you will be charged. This is known as progressive rate. Higher the income, higher the rate. So for non-savings and savings, the rates are same. Both basic, higher and additional, 20, 40, 45. But for dividend, basic is 8.75, higher is 33.75, additional is 39.35. Now, this example 1. So you have been given an income of 160,000. This 160,000 immediately you cannot charge 45,000. Yes, you might say 160,000 is more than 125, 140. You start charging 45%. That's not how it works. It works in slabs. First 37,700 will be charged at basic rate, and this is non-savings. So 37,700 at 20, the balance 87,440 at 40, and the additional, the excess is charged at 45. That is 34,860. So you add all three and you get your income as 58,203. This is your income tax liability. Now, savings income. All forms of interest received is savings income. Okay. And non-savings income is all income which are not savings or dividend. Most interest is now paid gross. That means nothing has been deducted at source. Those type of savings which are still paid net of tax will not be asked. So thank God, everything is gross. Next. So first you have to charge tax the non-savings income. First slice. Second is savings, third is dividend. Okay. This order you have to remember. Then personal allowance. If you have personal allowance, any deductible interest, any trade losses, first you will deduct it from non-savings, then savings, then dividend, because this is the most beneficial way. There are some complicated situations also, but they will not be asked in tax. In ADX, yes. Now, taxation of savings. For savings, there is a benefit, additional benefit. What is it? If your savings income, okay, if your taxable income falls within the first 5,000, that means all of that taxable income is savings only. That means first 5,000 income is your savings income. You don't have any non-savings. Non-saving is zero. Savings income first 5,000 is taxed at 0%. Okay. And the extent of the savings income nil rate VAT is known as savings income nil rate VAT. It depends on the how much of the income is there for non-savings. Okay. So savings income nil rate band. There are two things. One is starting rate, where first 5,000 is taxed at 0%. The other one is a nil rate band, savings nil rate band, where your savings income will be taxed at 0%. Okay, if you are a basic C, you have to see at what rate you are. If you are a basic rate taxpayer, you are going to get a savings allowance. That means 1,000 of your savings will be taxed at 0%. If you are a higher rate, then only 500 of your savings will be taxed at 0%. It is known as savings nil rate band. We have for dividend also dividend nil rate band, but we don't have anything for non-savings. Okay. For additional rate taxpayers, there are no savings nil rate band. And savings income in excess of the nil rate band, that means you have utilized the nil rate band. After that, it will be normally 20, 40 or 45%, depending on you are in which level. So now we'll be doing questions. Example 3. So in example 3, we have 4 separate people, Alex, Bernie, Charlie, and Danny. And for each of these 4 taxpayers, we have the same amount of savings income, that is 4,000 each. But the other income, like salary, is different for each. Then we have the net income. We deduct the personal allowance based on the net income. As you can see here, this is already done. This is 12,570 because the net income here is less than 100. Here also is less than 100, so we have 12,570. Here is 106, making this 9,570. We'll see how. You can use a calculator for it, or you can do it in the Excel straight away. Okay. So here, if you're using the calculator, 106,000 minus 100 divided by 2. So you have to deduct 3,000 from, this is the reduction, the amount. So 9570. They have already calculated and given to you. And here, since this is more than 125,140, personal allowance is 0. And they have given you the personal allowance. What you have to do is, you have to calculate the tax payable. Okay, so we'll do it in the spreadsheet. So when we are doing in the spreadsheet, we have, remember we have 4 separate people, Alex, Bernie, Charlie and Danny, and we have to start with the salary first. Non-savings income first, then we tax the savings income. Okay. So here we are going to write Alex, Bernie, Charlie, Danny. Okay, I'm writing the initials of each people. Now the rate. So here since this is in a vertical format, okay, make sure that you use the proforma. So this personal allowance will be deducted from the salary first. Okay, if you use it, okay, we'll see how much. So 21,500 minus 12,570, 8,930. So if you see non-savings 8,930 is non-savings and it is at basic rate. If you see this taxable income, this will help you to decide at what rate you are. You are a basic rate taxpayer. Entire amount. So 8,930. So this is 20%. 8,930. Non-savings will be taxed at 20%. We'll write the name later. So just do it here. Just apply this, multiply by this. Done. Okay. So nothing to do at this one. Now we have savings. If you see this amount, salary 21,500. If you deduct personal allowance and calculate the tax, non-savings entirely went. Now you are left with savings. So savings out of 4,000, 1,000 will be taxed at the starting rate because you are a basic rate taxpayer. So saving will be taxed at 0%. Okay, we'll keep here 40%. We don't have dividend, so we can keep it at 45. This is for other, remember, and this is for savings. Savings will start with 0%. 0%, 20, 40, 45. So savings here, out of 4,000, 1,000 will be taxed at 0%. If you drag this here, so here, okay, I will undo. You see, it is 0 into 1,000. And then the next will be taxed at 20%. That is the 3,000. So just drag this here. Automatically, it will calculate. And here, the sum function. Done. So this is your total tax payable for A. Now same will do for B. using the same rates here. You don't have to copy paste the rate every time. This is time efficient. So now we'll go to the word processor and see here 47,700. You deduct personal allowance from this 47,700 and we'll see. So which is 34,430. So it falls fully under basic rate 34,430. 34,430. So this will be taxed at 20%. This it will be taxed at 20%. 20% into this. Done. Now we are left with savings of 4,000. Remember, partially it will fall in the basic, the other one will fall in the higher rate. If you see this, it's high rate taxpayer. Okay. So here, how will you decide? Because higher rate, so he is entitled to savings nil rate ban of 500. Okay, 500 will be taxed at 0%. So here 0% into 500. Done. The balance, if you want this, it is equal to, what is the basic rate? 37,700 minus this minus 500. Done. So this will be taxed at 40%. No, this will be taxed at 20%. This is the basic rate. Okay, this will be taxed at 20. Done. Now the balance will be taxed at 40%. What is the balance? So to know the balance, we'll go to the here 4,000. So out of 4,000, if you see here, 500 goes and this goes. So 4,000 minus this 2. Done. Okay, it's not taking, so we'll take this minus this. So this 730 will be taxed at 40%. That is a higher rate. Okay. The balance. Done. So now the sum function. You see 7, 7, 3, 2 for B. Now same thing we'll do for C. So for C, if you see it's 102. So from here we'll deduct this personal allowance and see. Okay. Nine to 430. But remember this 9 to 430 entirely you cannot tax at one rate. Partially at savings, partially at higher, partially at basic rate. So first 37,700. This minus 37,700. Okay. So 54,730 will be taxed at a higher rate. First 37,700 will be taxed at basic rate. Then 54,730. We'll take it from the calculator. So here, this multiply by this. 40 multiply by this rate. And here if you see, whatever the savings nil rate band, you will not get it. Why? You are an, look at the taxable income. You will get, you are a higher rate taxpayer, not additional rate. So 500 you will get out of 4000. 0. So the next 3500 will be taxed at 40%. Now the sum function. Done. Now the last D. So for D, 160. So from here nothing to deduct, no personal allowance. So this 160, first we'll take the basic, then the higher rate, and then the additional rate. So 37. First 37 700 at basic rate, which will be 7540. Next 87. What is the higher rate band? 1 2 4 5 140 minus this. Why it didn't calculate? Because I didn't put the equal sign. 87 440. This will be taxed at 40%. Done. Now savings 4000, no nil rate band because higher rate tax, additional rate tax by 164. So entire 4000 will be taxed at 45%. Here. So now we'll add up all the three. There is a mistake I have done somewhere, for which the last one is giving me an error. It's this. I forgot to take the non-savings, this 160, the additional rate I forgot. So it is 160,000 minus this. No. Minus this. 34,860. 34,860. Which is at 45%. So this is the, these are the 4 tax payable for the 4 people. Okay. So make sure that when you are writing the answer like this, we bold this out so that separately the answers stand out. Okay. So here is the screenshot of example 3 that I've just done. You can see and go through each of them. Now, special case, 0% rate on savings income. So where your non-savings income does not exceed 5,000, your savings income will be taxed at 0%. This 0% is different from the savings nil rate band. Okay. And so the starting rate is available in addition to the savings income nil rate band. Two advantages. One is the starting rate 0%, the other one is the savings income nil rate band. In some cases both might be available. If your income does not exceed 18,570. How 18,570? 5,000 of savings plus 1,000 of nil rate band, that is 6,000, plus the personal allowance 12,570. If you add, so your total income should not exceed 18,570. Okay. If your total income does not exceed 18,570, you don't have to pay any tax on the savings income. After this, whatever the income you have will be taxed at the normal rate, 20, 40 and 45%. Now, so this 0% starting rate will apply in certain condition. Let's say first one, where you have a children with substantial savings income but no employment income. That means everything falls under savings. So his entire first 5,000 will be taxed at 0% plus the rate band 1,000 0%. But this will not be asked in your tax. Next, you are having a spouse with substantial savings but not so much of employment or self-employment or property rental. Pensioners whose earned income is largely covered by their personal allowance. In this condition, you are going to have the 0% rate on savings income. Now, activity 3. So we'll go through activity 3, where you have been given the state pension, private pension, and savings income received. You have to calculate income tax payable. So let us quickly do that. So now let us start the activity 3. So we'll divide into non-savings and savings. Okay. First column I'll keep for description, savings and total. Now, so we have state pension, private pension, savings income. So quickly do that. State pension SP, private pension PP, and savings income. Savings. So state pension and private pension both will fall under non-savings. Okay. 65,870 and 8,400, and this 4,800 is savings. 6587. So we'll go under total also. And then 8,400, 8,400. Then 4,800 goes under savings. Total also will write. And then total income. I'm going to drag this. So now I'm going to do the sum function here. And I'm going to drag this to the other side. You see? Now, from total income, we'll deduct personal allowance. So here total income, everything is less than 100. Okay, you can't write minus, just write less personal allowance. So total income is less than 100. So personal allowance full amount you will get will deduct from non-savings minus 12,570. Okay. So here I'm going to copy paste this here. Paste. You can calculate the value or you can calculate with the formula. It's always better to calculate with the formula. So taxable income. Sum function. From total income deduct personal allowance. Done. And I'm going to drag it to the other side. Done. Now taxing. So taxable income is done. If you see your non-savings here 24,170 is less than 5,000. So part of non-savings will be taxed at savings will be taxed at 0%. So here we'll take 2417, and this entirely will be taxed at 0%. So this is taxed at 20% because this is non-savings. We don't have the starting rate for non-savings. Okay, then here out of the 5,000, okay, so we have to see that this one taxable total income, this one. So out of 72170, 5,000 minus this, 2580. This is the starting rate, 0%. This if you add it's 5,000. Okay, and because this is basic rate, nil rate band of 1,000 is also applicable, 0%. And then the balance. So it is this minus all this. Minus this, minus this. This will be taxed at 20%. This is for savings. So here, just apply this once and drag it down and perform the sum function here. You see? But you have to deduct the payee because you are told income tax liability or payable. Income tax payable. And the amount that you have calculated is income tax liability. So you have to deduct this 5,970. The payee needs to be deducted. It could be payable also, it could be repayable also. That's why the question remains open. So now this is, you have to write it, it's income tax liability. Now you have to deduct the payee from this, which is already given to you here, 5,970 minus 597, and get your income tax payable. Again, you can perform the sum function. And this you can round up. Let's go here. Go to custom. Put this. Okay. So 130. This is your income tax payable. I have copy pasted the answer of activity 3 here. So as you can see here, it's 129. Now, taxation of dividend income. So we are finished with non-savings and savings. Now we are moving on to dividend income. Dividend income is received gross, and taxpayers benefit from a dividend allowance which is 500. Okay, but there is a difference. We don't deduct dividend allowance from taxable income. Okay, it's a nil rate band, like how we have a savings nil rate band for the basic rate taxpayer 1,000 and for higher rate 500. Same way, irrespective of your income, taxable income, an individual, a taxpayer are eligible for dividend allowance of 500 always. That means first 500 of your dividend are always taxed at 0%. That is the meaning of nil rate band. Okay, so and this is applicable for all taxpayers. So your income level does not matter. But the savings nil rate band, the 1000 and the 500 depends on your taxable income. If you are a basic rate taxpayer, you get 1000 savings nil rate band. If you are a higher, then 500. And if you are additional, no nil rate band. But dividends in excess of 500 will be taxed at the normal rate. 8.75%, that is basic rate. 33.75, that is higher rate. 39.35, that is additional rate. Now, so we will move on to example 4. 2 questions we'll be doing for dividend income. So let us start with example 4. Example 4. So here we have 3 people, Jerry, Kylie and Lou, and they have the same amount of dividend income. But the other income are of different levels. Okay, as you can see here, salary 21,500, 47,500, 160. Looking at salary itself, you can see Jeremy is a basic rate, Kylie is at higher, and Lou is additional rate taxpayer. Now dividend remains 12,000 for all the 3. You see here, 12,000, 12,000. Okay, now, so looking at the first 2 scenario, adjusted net income is less than 100,000 here and here because we don't have any gifted donations or nothing to adjust. So our net income will be same as adjusted income. Therefore, personal allowance you can deduct completely 12,570, 12,570. But here in this case it's 0. Why? Because if you see here your net income, which is also your adjusted net income in this case, is more than 100,000, more than 125, 100 in fact. This is 172,000. So no personal allowance, and you get your taxable income. Once you get your taxable income, what are you supposed to do? You're supposed to calculate the tax payable. Okay, so now let us do the tax payable. So here if we do, I'll keep both the windows open here. So tax payable will do for Jamie first, J. Will do for Kylie, K. And Louis, L. I'm not decorating or doing any kind of formatting right now, that you can do. Okay, so now see here, if you open this, your taxable income is 2930. Everything will be taxed at what? Basic rate. Okay, but since we have dividend also, we have dividend nil rate of 500, you have to be very careful. And also when you're deducting your personal allowance, remember this is the total figure, but personal allowance we always deduct from non-savings first because it's tax beneficial. So we'll deduct this 12,570 from salary 21,500. Okay, so you can straight away do it here itself, equal to 21,500 minus 12,570. So this will be at the rate of 20%. Okay, so when you apply 20% here, this will multiply by this. Done. Now moving on to dividend. Dividend is 12,000. Out of 12,500 will be taxed at 0%. That's dividend nil rate band. You can straight away just drag it. Automatically the formula will be copied. Now here the remaining. So 12, it's 500, and from 12,000, if 500 goes, you're left with 11,500. This will be taxed at the basic rate. What is the basic rate? Dividend basic rate. 8.75. Often students make mistakes in this area. What do? They go and start putting 20%. No, it is not non-savings, it's dividend. Just drag it here. Automatically the formula will be copied. Okay, it's 1006 because 8.75 into this. Okay, you can round this figure up by going here and go to custom and click 0. Okay, done. You see, so now calculate the sum function to know the total payable. Done. This also go here, click here, custom, and press the 10 brings to whole number. It's always good to keep your answer as a whole number. 2792. So this is for Jamie. Jamie. Okay. So this is for Jamie. 2792. Now what I will do in the same space, I will just change the person and the rate automatically will change. Why am I doing this? It saves time. So easily, quickly I can show you the effect. But what you have to do, you can't do that in your exam. You have to separately put K and L. All three people have to be shown separately. This is only for illustration purpose I'm showing here. So straight away, J becomes K. Okay, we'll go here. See his rate 47,500. We'll deduct personal allowance from that. Rest, dividend and everything remains the same. 500 relative and 11,500. Okay, so this will be 47,500. 47,500. Automatically you see it's at 20% and this is the rate. Okay. So now wait a minute. So this will be now what's next? Dividend. So from dividend 12,000. 500 will be there. Okay, remember from the basic rate we can still take some amount. Okay, if you see this figure, this is a high rate 47. We'll deduct personal allowance and see what is the amount. 47. You see 34,930. So this falls in the basic rate and this is your rate. Now this will remain same 500. This amount also will remain same, but this will change. Remember, from basic, some portion of dividend will be taxed at basic, some higher. Okay, we'll keep a recurring total. Okay, add all this. See, we'll take this too and check. Still some portion could be taken in the basic rate out of this. You see basic rate is what? 37,700, isn't it? So from 37,700, some of it will be from this 11,500. Some will be at basic, some at higher rate. So if you want to know this, it is 37,700 because basic rate is that, and this is for the equal sign minus this. That is 7,700 minus this amount. Enter. You see this one is at basic rate 2 to 70. The next, which has to be at higher rate, that's also easy. So from 12,000, just work out the difference. This minus this, the balance. This will be at higher rate, that is 33.75. You see, automatically everything is adjusted. Okay, let's track this here. Just take copy paste this, automatically some function will be done. Okay, but there's a mistake which is done here. So just do the sum function. Since I haven't locked the cell, let's take this. Go here, this custom 0. Okay, you see 10,300. Now I will change this to Louis L, additional rate taxpayer. So Louis, if you see here, 160, no personal allowance. So we'll divide this into basic, higher and additional. Okay, first 37,700 basic rate. Next, for higher rate 87,440. This is at 40%. Okay, now the balance for additional rate. By the way, you should know what is this one, the level of additional. What is the additional level? 125, 100 minus this 2. And it's not performing, so we'll separately minus this, minus this. Okay, there is a mistake here. So before we find this figure, let me show you how did I get this figure. Okay, so put an equal sign. The limit for the higher is 125, 140 minus this, the basic rate. So the width, so this much will be charged at a higher rate. Okay, now here I want to find the excess. So if you go here, you can see here we don't deduct any personal allowance, so salary is 160,000. So here just put an equal sign, 160,000 minus this and minus this. The excess will be charged at additional rate, which is in this case 45%. Now we are coming to dividend. Okay, so dividend is 12, that means 500 dividend allowance and 11,500 at additional rate. So this is 0%. This is dividend, and here the additional rate for dividend is 39.35%. 11,500. I'll just drag this down here. Done. And now here I'm going to perform the sum function. Go here, general, custom, this. So it is 62,728, the total tax payable for Louis. Okay. So now with that we are finished with example 4. Now I'll move on to activity 4. As you can see, Robert has the following income. Okay. From employment 45, 40,500, savings 10,000, dividend 500. That means Robert has all the three types of income: non-saving, savings, and dividend. With that, he has a tax that was deducted at source 5795, and also tax was deducted source from 40,500. It was deducted from this under the payee. You are supposed to calculate income tax payable. Please always check whether they are asking you income tax payable or income tax liability. If it's income tax liability, you don't deduct the payee. If it's income tax payable, you deduct the payee. Okay. So now let us start with that. Okay. So that's A. There is part B to this. Facts as in A above, except employment is now 143 and tax deducted is this much 57. Now you calculate the income tax payable. Okay. So now looking at the level of the income, one can predict whether he's a basic, higher, or additional. You don't need full income tax computation. So looking at earnings, savings, dividend, if you add, it will be at higher rate. It will not fall into additional rate. Okay. So he's a higher rate taxpayer in this limit. When it comes to part B, where employment is 143, if you add, your savings and dividend remains the same. Only the employment income changes. Then he falls into additional rate taxpayer because 143 is above the limit. 125, 140. Okay. So now we'll do the calculation. So when we do the calculation, what do? Divide it into three columns. Non-savings, I'll write NS, savings S, dividend D, and total T. Okay, now I'm going to write the employment income. E, employment income. Then savings S, dividend D. You don't do this in your exam. This is I'm doing in order to save time. I'm using the initials rather than writing the full form. So here, this is part A, okay? Employment income you will write under non-savings. It's very important to categorize the type of income into the three categories properly. Otherwise, you will lose away few marks. So non-savings 40,500. Savings income. Interest falls into savings income 10,000. And dividend falls under dividend 500. Make sure you write the total. Just perform the sum function in one and drag it. Even though there is nothing in this cell, still make sure that you copy paste. Okay. Now, so here total income is equals to net income. Here your total income is equal to net income because you don't have any other adjustment like gifted, donations, or charity, nothing like that. So this is your total net income. Net income is the sum function. Just drag it to the other cell. Now, personal allowance. Do not forget the personal allowance. Where you will deduct from non-savings first because it's beneficial. Minus, you can deduct the entire amount because net income is less than 100,000. This will come here as well in the total. Do not forget to add it in the total. Now, what you get is your taxable income. All these things you have to do at a higher speed. That's why you have to keep on practicing this type of different incomes, and you have to keep on calculating tax payable. with different questions so that you can do this at high speed. Okay, now let's do the sum function. So now that's done. Now let us do income tax. This is the taxable income portion. Now I'm moving on to income tax part. So income tax, first always start with non-savings. Non-savings basic rate. Okay, if you see here, from net income you can do from taxable income. So the entire amount of non-savings falls under basic rate, 20%. 20% is the basic rate. So just copy paste here. Remember, if you're copy pasting it, since there's a function to this, either you can copy it with the formula or just the value. I will just take the value. Okay, now put an equal sign and take this and multiply this with this. Now, non-savings, this is entirely completed, done. Moving on to savings. Remember, savings, there's a nil rate band for savings. Okay, nil rate band. So because looking at this taxable income, he's a higher rate taxpayer. So he's eligible for savings nil rate band up to 500 only, not 1000, which is at 0%. Nil rate band 0%, so 500. Just drag this down. The formula will be copied already in the next cell. Now the balance. So out of 10,500 goes for nil rate band, the basic at higher rate. High rate for saving is also 40%, same as non-savings. The balance 9,500. So 9,500. So remember, there's a basic limit. Often students make this mistake. Do not make this mistake. Why? Because some portion of this 9,500 will fall on the basic and some into higher. So that's why to find this, how much of it will fall in the basic? 37,700 minus this minus this. So out of 9,500, 9,270 will fall in the basic. The balance, small amount, will fall in the higher. So this is also at 20%. Now comes 40%. So the balance is what? 9,500 minus this amount, 230. 230 will be taxed at 40. Okay. Now for dividend is just 500. The entire 500 will be at 0%, nil rate band, because it's covered by the nil rate band. So dividend, nil rate band, 0%, 500. So now let's do the sum function here to calculate the total income tax. Done. From here you have to deduct payee. Payee. How much? Minus. What is the payee? Payee was 5795. 5795. Do the sum function here. Done. So the income tax payable is 1737. Now let us go to part B. What I will do is I will just adjust the figure here in the part A. But you have to do B separately once again. You can't do it in the exam. Alter B in the A's figure that you can't do because examiner needs both part A and part B as your answer. But this is I'm doing in order to save time. Okay, so let us start with part B. So part B, I will just change the figure of non-savings to 143,000. Everything else changes, everything else remains same, but here now we can't deduct the personal allowance. This I have to remove. Okay, no deduction of personal allowance. So now non-savings. This 143 will fall in the basic first 37,700 at basic rate, then next 40%, that is 87,440 at higher and additional rate, the balance. How do you get the additional rate? Just take equal to 143,000 minus this and minus this. Done. So this is at done. Now coming to savings. Because he's an additional rate taxpayer, no savings nil rate band. Entire amount will be charged at 45% for savings. The 10,000. Okay. And now for dividend nil rate band is there. So now after calculating, this is your this one and your payee is 5798. So 4255 is your income tax payable. So the answer for example 4 is here. I've done all this where I've calculated this tax payable on this. Now activity 4 also I've done. I've taken a screenshot and copy pasted in the slides here. So this were the answers where I've calculated the tax at two different level, higher and additional. Now deductions from total income, the fifth part of this lecture. So deductions from total income. These are the things that you can deduct from total income, okay, to arrive at net income. And they are deducted before personal allowance. Now in tax, you should always remember the order of deductions. What needs to be deducted before what. And the ones which are relevant to your exam, that is relief for interest on qualifying loans and relief for trading loss against total income, you'll be given one of this in your exam, or you might be given both. So these are the two important things: qualifying loan, interest on loan, and the trading losses. Relief for qualifying loan is taken before the loss relief also. Why? Because unrelieved trading loss you can carry forward in future to get a relief against the income, but unrelieved interest you can't carry it forward. It will be wasted. That's why that is relieved first. So first qualifying loan, then trading loss, then personal allowance. This is the order. Now, qualifying loan interest. What is qualifying loan interest? Qualifying loan interest is an interest on a fixed loan. Any interest on a fixed loan, but not a bank overdraft. So if you have taken a loan for a qualifying purpose and you are charged interest on that interest you can deduct as an expense. From your total income you can deduct. So this are like they're giving you further incentives for you to deduct your tax, because from your total income if you deduct the interest your tax will be lower, but the loan has to be for a qualifying purpose, not any purpose, and it should not be a bank overdraft. It should be a fixed loan. Okay, so these are the qualifying purpose and you should remember this qualifying purpose. You have to see in your exam whether the loan that is taken falls under this qualifying purpose or not. If it falls, then you deduct. If it does not, you can't deduct. First, purpose. If you are purchasing an interest in partnership, okay, if you are taking a loan to purchase an interest in partnership, that interest you can deduct. Okay. Next, when you're purchasing a plant and machinery, let's say a partner is taking a plant and a machinery to use in the partnership business. Okay. Or a shareholder is purchasing a plant and a machinery on behalf of their company, or an employee is purchasing a plant and machinery for using in the employment, then any interest you can deduct. But this interest, there is a limitation. You can only deduct the interest for first 4 tax years. After the first 4 years, there is no deduction. So when you purchase plant and machinery, let's say a shareholder has purchased a plant and machinery on behalf of the company, they can deduct the interest for first 4 tax years. After that, no. If a partner has taken plant and machinery for using in their firm, first 4 tax years. If an employee has taken plant and machinery for their employment, first 4 tax years they can deduct that interest. The next, qualifying purpose. Third, when you are purchasing a share in an employed owned company. What company? Employee owned, not any company. So these are the 3 qualifying purpose. Now moving on to the qualifying loan interest. Okay. So the tax relief that you are getting, that means the deduction from the total income, there is a limit. Maximum you can deduct is greatest of 50,000 or 25% of the adjusted total income, whichever is the greater. And this cap on income tax relief will only be examined where trading loss is claimed against total income. So for you, the easy thing is, remember this deduction of 50,000 or 25% of adjusted total income will only be asked when you are also given a trading loss relief. When you are not giving a trading loss relief, they will not ask this question. They will not give you this limit. Now, moving on to activity 5. So let us do the activity 5. Activity 5. So in activity 5, we are going to go through the income and the loan interest. So we have tax adjusted trading profit of 54,500, and then we have bank interest of 1,000, and during the tax year, Alas paid 2,000 of interest of the loan taken in 2016 to finance her contribution to the capital of the firm in which she is a partner. So looking at the condition, you can see that this is a qualifying loan. They have taken for qualifying purpose, but just look at the year. It is taken in 2016 and you are in 2024-25. So the first 4 tax years you can deduct. So now let us quickly go to the spreadsheet. We have 2 types of income, non-savings, NS, savings, total. Okay, so for non-savings we have the trading profit is non-saving income, which is 54,500. Then savings will fall under savings, which is 1,000. And the total, just perform the sum function, take both and drag it to the next cell. So you can copy paste to the other cell, even if there is no figure. Now, total income. Total income. So the total income, again perform the sum function, take both, enter, and drag it to the other cell. Done. And now, remember before personal allowance we deduct qualifying loan interest. Here. 2000. Okay, 2000 loan interest. So this 2000 he can deduct now. Loan interest, loan interest. 2000 minus 2000. It's better to deduct from non-savings because we have higher income here rather than savings, because savings we just have 1000. Okay, now what we have is net income. So from total income, remember, from total income, this is very important. From total income we deduct the loan interest and get the net income. Now we have to perform the sum function. And next we have personal allowance. Personal allowance. So personal allowance, you can deduct the entire amount because net income, if you see, is less than 100,000. So 12,570, the full amount you will get. Here also is minus 12,570. This is the taxable income. The result is taxable income. These are three important figures: total income, net income, and taxable income. You have to know what is deducted to get what. From total income, you deduct the interest and get net income. From net income, you deduct personal allowance and get taxable income. These three are this important subtotal which you can never forget. And I'm going to take it to the other cell as well. Okay, so taxable income part is over. Now I'm moving on to income tax. Okay, so first non-savings. If you look at the taxable income, partially savings, partially at basic, partially at higher rate. Okay, so here 20%, 40%. Looking at taxable income, you can see he is a higher rate taxpayer. So here 37,700. Now the balance. This minus this. So this, put an sign and multiply this with this. Just drag it to the next cell. Copy paste. Now we have savings is a higher rate, so savings nil rate band is 500, which is 0%. 500 because higher rate 500. And the balance from 1500 goes, now you are left with 9500 at higher rate, which is 40%. Sorry, 950. I'm sorry, 9. It's 500. I'm sorry, it's 500. I forgot. Half of 1000 is 500. Now take the sum function and get the total income tax payable. Add all the income tax calculated. 8632. This is your income tax liability, not income tax payable, because you did not deduct the payee. The question in fact asked you income tax liability. So this is the answer for activity 5, the qualifying loan interest, where we have calculated the income tax liability, which is 8632. Now we are moving on to the sixth part of this lecture, which is donations to charities. First is payroll giving. So here an employer sets up an approved payroll giving scheme. Okay, so employees can treat these gifts to charities, okay, that are made out of their salary as allowable expense. That means anything out of their salary that is given to charity, they can deduct as an expense from their salary. But although the relief is strictly given as a deduction, that means you can only deduct this from employment income. But the relief is actually given at source under payee. Even though you are told you can deduct from employment income, but actually it has been deducted under payee. So employer deducts this gift from the employee's salary before the employee receives the salary. Okay. So the payroll gift deducted must be authorized by the employee and paid to the designated charity through an HMRC approved agent. Then only you can deduct. Otherwise you can't. If it's not an approved agent, if employer has not been authorized, they have not given you the authority, then you can't deduct the payroll gift. So there is no limit to the amount an employee can give each tax year. You can give any amount. Next, donations under gift aid scheme. If there is a donations, then how it is accounted for. So any taxpayer can make any donation to charity, no matter whatever their total income is. Okay, you can either make one of single payment, or you can make a series of payment over time as a donation. Any amount can be donated and you can attract the tax relief. You can get the relief on it. Now, strictly speaking, give aid donations to charity rank as deductions from total income like qualifying loan interest. That's why it is very important. How we deducted just now the interest from qualifying loan interest from total income, same way we can deduct gift aid donations also. So this is how the tax system deals with the relief in different ways. Okay, this is how they deal with the gift aid donations. If you are a basic rate taxpayer, then 20% relief is given at source only when you have made the payment. That means the taxpayer only pays the 80%, the net amount, to the charity. And the payment is ignored in the income tax computation as complete relief has been given at source, because you have been given the source. You have been given the relief at source, the 20%. Therefore, when you are taking the income tax computation, the payment is ignored. And if you are a higher and an additional rate taxpayer, you extend the band. The higher rate and the additional rate bands are extended by the amount of payment, by the amount of gross payment. Remember, the payment you are given is net payment. You have to gross it up. So charities as non-taxpayers, they are entitled to the gross amount. So you can reclaim this amount from the HMRC. Let's say if a taxpayer wanted to gift 100 to charity, individual will only pay 80 to charity. And then the charity would claim the balance 20 from HMRC. That's how it works. You don't give 100 straight away. You want to give 100 to charity, you only give 80. The balance 20, charity will claim from HMRC. That's how they get the 100. Now, extended basic and higher rate relief. Most of the time you have to work on this. You'll be given a question where you have to extend your basic and high rate relief. Okay. Let's say you have a taxable income more than 37,700, which falls in the higher rate. But because now you have made some gifted donation, more of your income could be taxed at the basic rate, not just 37,700. Okay. So now your basic rate band will not be 37,700, it will be more. Same for the higher rate. If you are falling in the higher rate, if you are falling in the additional rate, more of your income would now be taxed at higher than additional. So now, how do we extend? We extend the band, whether it is higher or basic, by adding the gross amount of the gift aid payment. Whatever the gift aid you have made, gross it up and add it with the basic and the higher rate. So actual amount will be given to you. Just multiply 100 and divide by 80. You will get the gross amount. that amount, either you add with 37,700 to extend your basic rate, or 125, 140 to extend the higher rate. Okay, so that means how do you get the relief? The higher rate relief is given like this. Earlier, if you are higher rate, you would be taxed at 40. Now you are being taxed at 20%. And additional rate, earlier you are being taxed at 45. Now because of the extended band, some of your income or more of your income would be taxed at 40 rather than 45. So that's the relief. Same for the dividend, but the rates are different. If you are having dividend income, then the rates are different. It is 8.75, 33.75, and 33.75 that you have to extend. So now let us do activity 6, where we have to calculate the income tax liability of Catherine and Simon. Activity 6, relief for charitable donations. So here you can see Catherine and Simon are husband and wife, and these are the information regarding their income and the gifted donation that they have made. So now using this information, you are supposed to calculate the income tax liability for both. So you have the salaries from employment, gifted donation to charity, and payroll gift to charity. The amount paid to charity under both the payroll and the gift aid are actual amount paid net of 20% tax relief at source where appropriate. So now you are supposed to calculate. So when we are doing it for two people, like couples like this, always do simultaneously. This saves time. Catherine and Simon. Okay, next. So we have employment salary S. Remember, we deduct the gift aid and gifted donation from the salary. So the only income is what? Salary. So salary will take to Kate. Okay. S. Salary of Catherine is 21,500 and Simon 55,500. One is a basic rate, one is a higher rate. Catherine is basic rate and Simon is higher rate. Next, we deduct the payroll. Okay. So the payroll, if you see here, it's 1,000 and gifted donation. So first we'll deduct the payroll. 1,000. Remember, if it's payroll, we deduct from salary. But if it's gifted donation to charity, gift aid, okay, this 800 and 1,600 we do not deduct from the income. Rather, we extend the basic and high rate by the gross amount. That's the only difference between gifted and payroll. Payroll we deduct from salary, the income itself. So now, here the total income is equals to net income in this case. Okay, sum function. Now we deduct the personal allowance. Remember, total income is less than 100 for both, so full personal allowance you can deduct. Minus 12,570. Minus 12,570. Now sum. So this is your taxable income. So now we'll calculate the tax. For Catherine, we don't have to extend anything. Why? Because there is no benefit for Catherine. Because if you look at the taxable income, 8930, it's already under the basic rate, 37,700. So no benefit. Benefit is only for the higher rate and the additional rate taxpayer. They have to pay lesser tax at lesser rate. But he's already paying at 20 without the extension. Even after the extension also, he will pay at 20% only. So there is no benefit to Catherine, nothing to expend. So the full amount, 20%. So the income tax is 20%. Copy, paste. Now this into this. So this is for Catherine. This is Catherine's income tax. 1786. When it comes to Simon, Simon is a higher rate. Here we can extend. How much? 1600. This is net amount. You have to gross it up. So here it will be 37,700 at 20%. I get to the other side. Okay. Now, if you see here, so here with this you have to add equal to 1600. This is the net figure. How do you gross it up? Simply multiply by 100 always and divide by 80. Enter. So 2000 is the gross amount. So you add 2000. 39,700. Now your basic figure is 39,700. So 39,700 at 20%. Okay, so it is 7940. Now the excess. So the total is 40. 2000 would have been charged at higher. Now 2000 is charged at basic rate. 41,930 has to be total. So the balance is this minus this. This will be charged at the higher rate, 40. And the total will be this two. 8832 is for Simon. So this is the answer for activity 6. As you can see, the income tax liability for Catherine and Simon. Catherine is 1786 and Simon 8832. There is no benefit for Catherine because everything is at basic, but for Simon there is a benefit. 2000 extra is charged at basic rate rather than higher rate. Now moving on to pension. So as you can see, there are different types of pension. One is known as state pension or national insurance retirement pension. Here a person's state pension is funded from national insurance contribution. Remember NIC that you pay?
Okay, every individual in UK has to pay national insurance to the HMRC. So using that NIC that you pay, they are going to give you pension, which is known as state pension. That's how the state pension is funded from your national insurance contributions. And these NICs are payable by employees and self-employed. Later, we'll go through NIC. This NIC is in addition to the tax that you pay, the income tax that you pay to HMRC. Now, the annual pension that you receive is your taxable income. It's a taxable earned income of the retired person. Next type of pensions are private pensions. And there are two types of private pensions, occupational and personal pension. Occupational is the pension run for the employer's own staff. And it might be partly or wholly funded by the employer. The word occupation says it all. Occupational pension means you have to be in the occupation. Next is personal pension. This pension scheme could be funded by an individual for their own benefit. It's not funded by your employer. So now let us go through this diagram to understand the two types of pension better. Occupational pension. Pension run for the employer's own staff. That means employer is contributing to this scheme for the benefit of the employees. It is partly or it could be wholly funded by the employer. Why? Because employee is also going to fund there. Next, personal. This can be funded by any individual. Occupational. Membership into this scheme is not obligatory. Okay, it might be available to all the staff, but it's not compulsory you have to be a member in that scheme. Personal. This is available to any person. Even if they're already a member of occupational pension scheme, they can take part in personal pensions as well. Under both the scheme, doesn't matter whether you are occupational pension or personal, there's a tax relief, tax advantage if you are contributing into a registered pension scheme, not unregistered. Registered means the scheme that is approved by HMRC. In your exam, they will tell you whether it's an approved or unapproved, whether it's registered or not registered pension scheme. So, under both the schemes, pension that you have received, okay, you can take partly as a lump sum. That means a huge amount from that you can take as your pension. And this is tax exempt. That means no tax. But remember, the amount that you are taking, known as tax-free lump sum, you cannot, when you're taking it, it cannot exceed the 25% of individual's total pension fund available at the relevant date. If it exceeds 25%, you have to pay tax. Then it's no longer tax-free. Okay. And what about the remainder 75%? The remainder, you can it can be flexibly taken as withdrawal. That means you are taking it as withdrawal. And that is treated as an income. And income from withdrawals, they are taxed at normal rate. That is not tax free. Okay. Now, relief when you are paying into occupation. What is the relief? The relief, that means if you are making contribution up to 100% of relevant earnings, you are going to get a relief. But in pension, personal pension, contributions are paid gross into the scheme. Okay. There is no basic rate relief given at source. This is for occupational. In occupational, contributions are paid gross. Why? Because unlike personal, for occupational, there is no basic rate relief given at source. That's why it's paid gross. And the tax relief at all rates is given by deducting the contribution. So whatever the contribution is made to the scheme, it is deducted from the employee's income. That's how they give you the deduction relief. Let's say employees contributing 500 into an occupational pension scheme. That 500 you can deduct from the employment income. That's your tax relief. Now, employers also can help employees by making contribution into that occupational pension scheme. What about the employers contribution into that occupational pension scheme? If an employee is making a contribution into an occupational pension scheme, their contributions are tax deductible trading expense. This is from employer's point of view we are talking. So from there, you can deduct this from their employer's income. Or if it's a company, then corporation tax. Tax deductible trading expense for determining income, or corporation tax on trading profits. If it's a company, if you are self-employed, you'll be having income. But if you're a company, you are paying corporation tax, then you can deduct that from there. This, whatever employee is contributing, is treated as a tax-free income of the employee. For employee, it's a tax-free income. The contributions that employees are making are tax-free income for employees. Therefore, it's exempt from income tax. Now, employers can also make contribution into personal pension scheme. But in this case, whatever the tax arrangements that you have just studied now, the 2 bullet points, will be the same. So whether an employer is contributing into personal or occupational, tax treatments are same. So you don't have to remember anything extra. Activity 7. This is about occupational pension scheme. So let us quickly solve activity 7. Activity 7. Occupational pension contribution. So here we are supposed to calculate the income tax liability of parks. So the information we have been given is employment income 126,500, employees contribution 28,500. So looking at the level of salary, one can say that he is a additional rate taxpayer, and employees contribution 19,000. So let us quickly open the spreadsheet. So from salary, one 26,500, we can deduct the employee's contribution. Remember, salary, who receives? Employee, not employer. So employee's contribution you can deduct. Employees C. I'm writing employees contribution. So employees contribution in this case is 19,000. So we'll deduct 19,000. Now let us do the sum function. Okay, so now employers contribution. What about employers contribution? The 28,500. You do nothing. You do nothing. Why? Because we are calculating parks income tax. So in parks income tax, we don't have to do anything with the employer's contribution. When we are calculating employer's contribution income tax, there we'll deduct this from his trading profit. So now nothing to do with the employer's contribution. But does it mean that you completely ignore it? No, you have to make a note here saying employer's contribution 0. You have to write it. For that, you have been given 1 mark. And your total income is equals to net income here. Because no gifted donations or payroll gifting. No other adjustments. So in this case, it's 107,500. Then we deduct personal allowance, but if you see the net income is more than 100,000. So your personal contribution will reduce. You will not get the entire 12,570. But how much is the reduction? You have to work out here. Equal to 12,570 minus this minus 100. You need to put a bracket inside this because you're doing a long calculation, into half. Just put a minus sign outside. So this is your personal contribution now, and then comes your taxable income. It is simply the sum function of this two. So now we'll calculate. This is a higher rate. So at basic rate, 20%, 40%. How much? 37,700, and 40% the balance, which is 60. Okay, if you want to find the balance, it's this minus this, equal to this multiply by this. Now I'm going to drag it to the next cell and do the sum function to calculate the total income tax liability. 31,932. This is the answer for activity 7. Just now we have got income tax liability 31,932. Now we are moving on to relief for contribution into personal. So from occupational we are moving on to personal scheme. Here they can claim tax relief up to 100% of their contribution. Okay, 100% of the relevant earnings in which contributions are paid. So relevant earnings, very important for you to know what are relevant earnings. So what are the relevant earnings? Not all earnings are relevant. Okay, employment income, whether it's in cash or benefits, all employment income are relevant. Trading profit from self-employment, relevant. Property income from letting furnished holiday accommodation, relevant. So these are the three relevant earnings. 100% of this three income, if you have, add them together, 100% is the entire relevant earning, you can get tax relief. Now, so how do you get the relief? This is different from your occupational scheme. Contributions are paid net of 20% tax relief at source. If the taxpayer is not higher or additional rate, contributions are ignored because there is no benefit. But if you are a higher or an additional rate taxpayer, same way we extend the basic rate and the higher rate. Like how we do for gift aid, same we do for this. So any contribution into personal pension scheme, remember, you are always given the net figure. You have to gross it up. Same way how we do for gift aid donation. Then add the amount to basic or higher rate. Same like gift aid, it works same way. So this is activity 8. How do we get the relief for pension? Personal pension. Now let us do solve activity 8. Activity 8. So here you have been given information about Mark's income. Okay. Employment income 160, personal pension paid 38. This is net figure, you have to gross it up. And employment income salary. Looking at this itself, you know he's an additional rate taxpayer. So you can extend the high rate band. And what's next? The important thing, no personal contribution will be allowed in this case. But we'll see whether it's applicable or not. Just looking at 160, you can't decide. Why? Your net income will change. Because now you have personal pension contribution paid. That's why. So let's quickly calculate Mark's income tax liability. So you have been given the salary, 160,000, and you have been given, you have to calculate personal allowance. You have to make a working for this. It's important, even if it is 0. Okay. So here, what's your net income? In this case, your net income is you only have salary. So this is net income. This is under working you have to show. Net income is 160,000. Okay, so this is your net income. Now, from your net income, you have to deduct personal pension contribution, PPC. How much? The gross amount. Net figure is 38,000. Gross it up. Multiply by 100, divide by 80. 47,500. It makes sense because your gross amount will always be more than your net amount. Just put a minus figure to this because you have to deduct from net income. Now do the sum function. Remember this working separately you have to show. Okay, not in the main answer. So just do the sum function. Done. There is a mistake somewhere. I put more zero here. Done. So looking at this, it's not more than 125,140. That means still you are applicable to personal allowance, but it will reduce. So how much? It's this amount minus 100 into half. Okay, from here you have to deduct 12,570. So it's you have to put a bracket here because there is a bottom which is being performed. So from 12,570, this is not 1.2, it's half. Into half. There's a mistake done here. So this into half. This whole thing into half. Or you can do it separately if you can't do it in one go. Let's figure out where is the mistake. So you deduct 12,570 from the difference, that is this 112 minus 100,000. The bracket, multiply this, put a bracket, multiply it by 0.5, close bracket, enter. Okay, it should be less than 12,570. Just put a minus figure outside. Now perform the sum function. Done. Thus 1.5 again there's a mistake. This is taxable income. This will be taxable income. Okay, so that's it. This is the taxable income, but there has been a mistake that has been made in the answer. In the answer, it is shown as uh, wait a minute. The mistake is done here. Yes, I put more zeros in salary. So this is a very common mistake students often make in tax. That's why when you're dealing with big number, please make sure that you are putting the appropriate number of zeros and always count the number of zeros. Okay, so 160,000 became 1.6 million. That's why my answer was giving an error. Now the tax. So this is the tax. Remember, your basic rate will be extended now. Okay. So this is the gross amount figure. Already you have calculated. Don't do it twice. So basic rate will be 37,700 plus 47,500, and higher will be 125. This threshold you have to remember. 47,500. Just do the sum function. Take it to the next cell. That's it. So now that means 85,200 is basic and this is the higher. So out of this, at 20% this much will be charged. Just copy. When you are going to paste, you can just take the value or the formula. With the formula you can take this multiplied by this, and the balance this minus this at 40%. Sorry, the higher rate is also expanded, right? So there's a mistake here. No, that's the correct. There is no mistake. Because if you see this is less than this amount is less than this. So the sum function, and this is your income tax liability. 44432. So here is the solution for activity 8. We have just calculated the income tax liability 44432. Now here the workings I've done for personal allowance and extending the basic and higher rate. Next we are moving on to people whose relevant earning is less than 3,600. So individuals who contribute whether to personal or occupational can get tax relief, which is a limit to the basic rate at 20% at source on contributions up to 3,600. This is the gross amount, this 3,600 per tax year, if they do not have any relevant earnings. Okay, let's say a person who is working abroad and whose earnings are not taxable in UK. So they are not relevant earnings, or your relevant earnings do not exceed 3,600. So up to 3,600 you will get tax relief. Now, annual allowance. This is annual allowance is the most an individual can save into their pension scheme before having to pay tax. So the total pension input is the sum of all your gross contributions, whether it's paid by the individual or the employer, into personal and occupational. So it's the you add up all your gross contributions into both the schemes by the employer and the employee. That's your total pension input. And if an annual allowance is not fully used in any tax year, you can carry forward this unused allowance up to 3 years. So the annual allowance for the tax year 2023-24 and 24-25, that means this year and the last year, it remained, there has been a difference. Last year it was 40,000. This year it increased up to 60,000. So annual allowance changed this year. Okay, for the tax years 21, 22 and 22-23, it was 40,000. So this year, this is the area where change has taken place. That's why when you are going to give any tax exam, make sure that you are referring the latest textbook with the latest financial year act, not the previous one, because there are changes. Next, unused allowances you can carry forward for any tax year if the taxpayer is a member of a registered pension scheme. If for any year, let's say a taxpayer was not a member of pension scheme, you will lose that year's annual allowance, you will lose. Okay. If the annual allowance includes unused allowance from the earlier tax years also, then you match the pension contribution with the current year's allowance first and then with the unused amounts. How? FIFO basis. First year first. First in, first out. That means the earliest year first, then the later, then the later, then the later. That's how. Definitely will do question. So a taxpayer with an unused allowance must make pension contribution in the current tax year of at least 60,000 plus the unused allowance of the earliest tax year if they want to get the maximum tax relief. That means up to maximum 60,000 you can contribute. With that, add the unused allowance of the earliest tax year. That is your maximum amount on which you are going to get tax relief. Beyond that, you have to pay tax. Tapered annual allowance. This is something new. Okay, this is something new. So for the year 24-25 and the later years, the initial annual allowance before you are bringing forward any unused allowance is subject to a restriction, tapered, if the taxpayer's adjusted income exceeds 260,000. This is something you need to remember. So if for your exam purpose, adjusted income, okay, and this adjusted income, we are talking from the point, there are two adjusted income now. We have studied adjusted income somewhere else while calculating personal allowance. Yes, and somewhere else. The restriction, 50,000 and 25% of adjusted income. Yes. So in for your exam purpose, the adjusted income for the tapered annual allowance can be taken as same as your net income plus employee contribution into occupational pension scheme plus contribution made by the employer into any pension scheme. I'm repeating this. Employee contribution only into pension scheme, occupational pension, employees, but employer can make contribution into any scheme, personal or occupational. They are added. They are added with net income. That is your adjusted income. That's for an employee. What about self-employed? If you're a self-employed, so for self-employed people, your adjusted income is just their net income for that tax year. Your adjusted income is same as your net income. And there are some other complications to this rule, and lower 200,000 threshold is there, but they will not be asked from you in your exam, so you don't have to worry about it. Now, this works in the same way how your personal allowance is deducted once your adjusted income is more than 100,000. Here, reduced by 1 pound for every 2. So you deduct 260. Okay. If your income is above 260, then only the tapered annual allowance will work. Otherwise, it's not needed. But remember, when you are deducting the annual allowance, the minimum it can reduce up to is 10,000. Beyond that, you can't reduce. Lowest is 10,000. Let's say you have an adjusted income of 330. So 330, if you deduct from 260 and take half of it, your annual allowance will be 25,000. Okay, you deduct that amount, 330 minus 260, take half of it and deduct that amount from 60,000. Your annual allowance will be 25,000. And if you are having a tax income of 360 or more, your allowance will be 10,000. Always 10,000. Why? Try it out by yourself and check. Put 360 in your adjusted income, deduct it from 260, take half of it and deduct from 60,000 and check. And check with 370, 380 like that and see. The amount is reducing more than 10,000. That's why. And the limit is fixed to 10,000. That's why it can only fall up to 10,000. Beyond that, it can't fall. So the easiest way for you to remember is, if your income is 360 or more, halas, allowance is 10,000 fixed. If it's between 260 to 360, then you have to work out. It keeps reducing. If it's less than 260, you do not have to worry. You will get the full 60,000 as your allowance. And any unused annual allowance you can carry forward. Okay. If your pension payment do not reach the tapped allowance, what happens? Remember, it is only the excess of the tapped allowance you can carry forward, not the entire allowance, only the excess. So a tapped allowance from an earlier tax year can only be carried forward and utilized in the current period. Can be utilized in the current period. In this case, tapped allowance carried forward would be provided within the question. They will give you what is the tapped allowance carried forward in the question, if there is so. Tapering applies on a tax year basis. So a taxpayer with a variable income, if you're having a variable income, you might be entitled to full annual allowance in some year and tapered in some other years. So a question will not be set involving tapering of annual allowance for earlier tax years. Earlier tax years, they will not give you the tapering. They will not give you such question, don't worry. Although a prior year tapered allowance might be provided within a question. They will give you the amount, but they will not tell you to calculate. So this is activity 9. Let us solve activity 9. Activity 9, unused annual allowance. So this question has some unused annual allowance and we'll see how we can make use of it. Now Tanisha is a self-employed and is a member of a personal pension scheme. This amount, her paid pension contribution net, they will always give you whether it's gross or net. Okay, so they have given you 3 tax years, 20, 32 and 32. Now her income, they have given you 311 and savings 1000. You are supposed to calculate the income tax liability, assuming she pays sufficient personal pension contribution to utilize the maximum personal to utilize the maximum pension annual allowance. So since you have been given a hint here that they are paying the maximum, to get the maximum allowance, you have to go by the rule. They have given you a hint. Advise Tanisha, this is the next requirement, as to the minimum amount of the personal pension contribution that she would pay in the tax year 24-25 if she would not to waste any of her pension annual allowance that is available for the next year 25-26. So there are 2 requirements here. First we'll solve the calculation part. This is the verb calculate, and the next is advice, where you have to write. So let us start with the calculation part first. Okay, 2 types of incomes are there, so quickly we'll draw the table. Non-savings, savings, savings and total. So here the trading profit, TP, which goes under non-savings, 311,000. So just rather than copy pasting, I would always suggest you to do a formula when you're going in the total column. So do the sum function because it's easier to copy paste later. And savings, interest, it's a gross amount, 1000. Just drag this down. Done. So your total income is equal to net income here. Just perform the sum function here, because sometimes you might have more than one amount. Here it's easier to copy paste the same amount or type the same number because you just have one. But some question has more than one. In real exam, you might be given more than one figure. So there sum function will save a lot of time and it's easier also. So this is your net income. from your net income, you're supposed to deduct personal allowance. Remember, even if your personal allowance after the workings you do is zero, still you have to write less personal allowance and write as a working one. If you're having a working, write next to it working one. You have to refer like this. Okay. Then keep some space and let us go to the working. There's a huge working here. So I will show the working here. This is working one. This is for personal allowance. So your net income is 312,000. This one, the total. From here, you are supposed to deduct gross personal pension contribution. Gross personal pension contribution. For this, there's a separate working. There, it's a working inside a working. So refer like this working too. Okay. Why? Because Tanisha has some unused annual allowance that is brought forward. That's why. First, we'll take the current annual allowance. Current year annual allowance, if you take, how much is that? So the current annual allowance for 2024-25. Okay, that's a separate working here. Working 2. Okay, so the current annual allowance. First, always start with the current year and then the brought forward. Current annual allowance. This is, and always write, mention the tax is very important because you have unused brought forward as well. 24-25. This is your current year. You are in this year, and your annual allowance. You have to calculate how. Looking at your net income, if you see your net income is 312, which is more than 260. So now your annual allowance will be tapered. Your annual allowance 60,000 will no longer be 60,000. It will reduce. So you have to do a working here. Okay, it will be equal to 312. Okay, it is simple as this. Minus, this is the working 260. This is fixed 260,000. Put a bracket. Multiply by half. If you put a bracket, the whole thing will be multiplied. It will be divided by 2, or you can simply divide by 2. So multiply by half or divide by 2 is the same thing. Okay, I will divide by 2. Divide by 2. Okay, this needs to be reduced from 60,000. So equal to 60,000 minus. So this is your current annual allowance. Now brought forward annual allowance. Earliest year first. So go here. What is the earliest year? 3 tax years. So 21, 22, 23. Okay, and this order will do. So it's 21, 22. 22, 23. And 23, 24. But remember, the amounts that you are given are what? Net figure. You have to gross it up. If you go here, see, her paid contributions are net. So all these contributions are net. 20, 32, and 32. You have to gross it up, and then you have to deduct from 40 the appropriate annual allowance for that year, because now your annual allowance is going to be tapered, it's going to be reduced. Okay. Now, so here when you're working it out, it's like this. This you have to remember, 21 and 22, this 2 tax year, the annual allowance was 40,000. Okay. When you come to this year and 24, 25, the current year, annual allowance is 60. So here, put an equal sign, 40,000 minus. You need to deduct from 40,000 because you are going to taper. How much? For that year it was 20,000. You have to gross up. The gross figure you will minus from 40,000. 20,000 into 100 divided by 80. This is how you gross. Put an bracket. So it's 15,000. Next. 22, 23. Okay. So put an equal sign, same, 40,000 minus, put a bracket. So check here, it is 32,000. So it is 32,000. This is the net figure. The gross figure will be multiply by 100 divided by 80. Close the bracket. It's 0. And for 23, 24, we deduct from the 60,000 minus 32. So this is unused, you are finding out, unused. These are unused annual allowance that are brought forward, 15, 0 and 20,000. So you have to deduct from the 40,000. Why? Because you have made some contribution. Here also 40,000, here from 60,000. So you have to deduct annual allowance by the gross contribution and find the unused amount. Now, to find the total allowance, just find the sum function. So it is simply 69,000. Okay. So now this 69,000 is what you need. Go to working number 1 and copy paste this here. This is what you need to deduct. I will take the value and paste it. Rather, I'll put a minus figure to it, so that this is automatically deducted from net income. This is annual allowance with unused and the current year. You deduct this from your net income. So perform the sum function. 243. So if you see 243, this is your adjusted net income, ANI, which is more than 125, 140. Therefore, no personal allowance. Okay. So there is no personal allowance. Now we can go to this main table and put here 0. No personal allowance. Here also 0. and just use the sum function. Drag this to the other side, and this is your taxable income. 311, 1, so total 312,000. Now we are going to find the tax. Okay. So the non-savings income tax will start with 311. Remember, basic rate will extend. You have to extend the basic and the higher rate now when you go to income tax. That's working number 3. We have already done it. We have extended it, I guess. We haven't? No, we haven't. So what is the amount? This is the amount, 69,000. Gross pension contribution, 69. So your basic and up higher threshold will exceed by 69,000. Okay. Basic, higher. Equals to 37,700 plus this one. Equal to 125,140 plus this one. This is your new basic and new higher rate. So now we'll tax this out of this 311, this entire amount 106, 700 will be taxed at 20%. This multiply by this, done. The balance will be taxed at 40%. So the balance is this minus this. Just drag this down. Wait, it's not 312. The higher is 195. There is a mistake. It is this limit minus the basic. Which is taxed at 40. Now, so up to this much is at higher. Now, balance will be taxed at 45%. How do you get the balance? It is simply this minus this 2. It will show an error. This minus this. 11,6,860. And now simply the savings 1,000. This there is no nil rate when because you are an additional rate taxpayer. So the entire 1,000 will be taxed at 45%. Now just add up the total of all the tax sum. This is your total income tax liability. Now moving on to part B. Part A we have finished. You have calculated the income tax. Now you have to advise Tanisha to the minimum amount of personal pension contribution they should pay in the 24-25, as if not to waste any of our pension annual allowance for 25-26. This is a future planning. Okay. So remember, when you move 1 year forward, you cannot utilize this year's unused tax year 21-22. Why? It's more than 3 years. Okay. So here is the answer. Okay, you cannot use 25 this annual in 25-26. So the minimum amount of personal pension that they must pay here, so that they do not waste any, say there's a condition. Okay, the contribution that they must pay 24-25 in order not to waste any annual allowance. Any annual allowance they say is 80% of 49,000, which is this amount. How did they get 49,000? Current annual allowance is 34,000. With that, they have taken 15,000. So here, this one and 15,000. They have taken 80%. Why 80%? Because these are gross figure. Remember, you need to find the net figure because you are paying net figure in the contribution, not gross. That's why. So it is simply add and take 80%. That is 39,200. This is the total annual allowance that one must pay in 24-25 in order not to waste any annual allowance. Any. That's a condition. Okay. So this is the answer for activity 9 part A, where we have calculated the income tax liability, which is 109,353. So we have three workings. Working 1 for personal allowance, where adjusted net income is more than 125,140, therefore it is 0. And working 2 is for personal pension contribution, where we have the unused annual allowance brought forward from the previous 3 tax years in the current year, and all are gross figure. Now, and this is working number 3, where we have extended the basic and higher rate by using the gross personal pension contribution that we have just calculated in working 2. And part B, this is a little bit tricky question for most because it's not a calculation, it is advice. So work on your advice portion when we are going through a revision of tax. That's more important. What should be a minimum personal pension contribution so that you do not waste any annual allowances? Now, annual allowance charge. So if the total pension input is more than your annual allowance, what happens? And that annual allowance includes unused amount as well. If it exists, the excess will not attract the tax relief. Remember, for that excess there is no tax relief. Then how is this excess dealt? Initially, giving relief for all contributions paid by the individual and their employer. And so initially you will be given the relief for the contributions, whether by the employer or the employee, but the excess will then be taxed as an additional taxable income at 20, 40 or 45%. Okay, there's a 10,000 annual allowance limit which will not be asked from you. Now, activity 10, where we have excess. So how do you deal with that excess is explained in activity 10. Now we'll go through activity 10. Activity 10. So now you need to calculate the income tax liability of Kenneth. For the tax year 24-25, taking into account the effect of overpayment of pension contribution. So this is the important word. Now, Kenneth is a self-employed, paid personal contribution net of 48,000. Total is 24,000. Unused annual allowance brought forward. His only income in the tax year is adjusted trading profit of 370. Okay. So now, what do you need to do? You need to find the adjusted trading profit. It's already given 370. Now, you need to see whether you can deduct the personal allowance or not from the tax adjusted trading profit. We have to find out the taxable income. Since we don't have any gifted donations, okay, so our total income will be equal to net income will be equal to, which is your adjusted trading profit. So there is only one income in this case, which is 370. So this is your net income, this is your total income. Okay. So in this case, this was from the earlier activity. I have the answers with me. So this is the adjusted trading profit, adjusted trading profit, ATP. Now here we have the total. Okay, so ATP is 370,000 and less personal allowance. So personal allowance, how much? We need a working. We need a working for that. Working one. So like this you will mention. Right now you can't decide just looking at ATP. Okay. So here net income is 370. 370. Okay. And from there you will deduct gross personal pension contribution. Gross personal pension contribution, GPPC. So in this case it will be 48,000. It's here. This 48,000 it's net. You have to find the gross figure. How do you gross it up? Into 100? You do 80. Minus 60,000. So this is your adjusted net income. ANI 310,000. So now it's more than 260. Sorry, this is for personal allowance. I'm sorry. This is more than 125, 140. Your adjusted net income. Therefore, personal allowance will be 0. So just do the sum function. Even if it is 0, rather than simply putting the number, always calculate the formula. It's very necessary. Why? When examiners give you marks, they will see this formula. Based on this, you'll be given marks. Okay. This is your taxable income. On this, you have to pay tax. Okay. On my left hand side is the main working, right hand side is the working. So now we have to extend, because we have gross personal pension contribution by that amount, we have to extend the basic and the higher rate. So now basic rate will be by 60,000. This is the amount. So it will change by 60,000. This 125, 140, the higher rate will change by 60,000. Okay. So now What's next? We have to find the tax. Exactly. So now we'll go to the tax. This is for non-savings. So non-savings basic rate is 97,700. 20%, 97,700, 40%. If you see here, taxable income is 370, and this is your upper. So you have to find the difference. This minus this, and the balance will be charged at 45 additional rate. So it is simply this equal to this, I'm sorry, this minus this minus this. It's equal to this multiplied by this. Once you do, drag it to the other side. Okay. Now, one more thing. What is it? You need to add one more thing. Annual allowance. Whenever you have some pension and when it's more than the limit, annual allowance charge. This is what you have to add with the tax. Annual, this is new. This I haven't covered before. Not always there will be an annual allowance charge, only when it's more than the limit, more than 60,000, like in this case. And it will be at the additional rate only, the highest rate, because this is taken after you calculate the income tax of all the types of income. That's why it will be at 45%. Okay. So how do you find out? Just go there and check. If you check this is the net contribution, but the gross is 60, right? And he has an unused balance brought forward 34, 24. But be careful. Why? Annual allowance for this, see this 24,000 brought forward. This is unused annual allowance brought forward in respect of the 3 preceding year. But what about the current year's annual allowance? How much? If you see that, okay, if you look this adjusted income, okay, you have to see the adjusted income, which is 370,000. It's more than the 260,000. So the minute is more than 260,000, there will be a tapering of annual allowance, and it could be it could fall down to minimum of 10,000. Beyond that, it can't fall down. So just do that. Just try to do that. 370. Just let's do a working here. 370 minus 260 divided by 2. Here it is From 60 it will be deducted because 60 is the annual allowance. We didn't put the equal sign. So 60 minus 370 minus 260 divided by 2. That's an issue. Okay, anyway. Okay, I'll put 60 here. 60,000 I'll put here. And here I'll put equal to 370 minus 260 inside bracket and divide by 2. 55. Okay, so if we deduct 55 from 60 is 5,000, but annual allowance cannot be 5,000. Minimum is 10,000. Therefore, annual allowance 10,000 of this year with 24,000 of the previous year. If you add, it's 34,000. So 34,000 is your annual allowance charge because it's more than the annual allowance limit, which will be charged at 45%. Sorry, it has to be deducted. That 34 has to be deducted from 60. I'm sorry. It is 60 minus 34. 26,000. 60,000 minus 34,000. Okay. So I'm repeating again. How did I get 34,000? This 34,000 is 10 from the current year and 24 brought forward. So 34,000. And you deduct from 60. Because 60 is the limit annual allowance. Beyond that only you will be charged the excess. So 60,000 minus 34, 26,000 is the excess, which would be charged at 45%. I'll just copy paste this here. That's it. So total income tax liability will be the sum of all this with the annual allowance charge. Which is 149,403. This is the answer. So here is the answer for activity 10. We have just calculated income tax liability with the annual allowance charge, which is 149,403. In the key point, they have also mentioned how did we get 34. 10,000 from the current year, which is tapered to minimum, and 24 unused, which is given in the question. Moving on to the workings. So these are the workings for activity 10. Personal allowance is nil because adjusted net income is more than 125,140. And in the second working, we have extended the higher and the basic rate by the gross personal pension contribution, which we have calculated in working 1, which is 60,000. Next is lifetime allowance charge. Until the tax year 2023-24, there was a lifetime allowance. But thank God this year, 24-25, it has been removed, abolished. So you don't have to remember. Next section of this lecture is on married couples. If you are a couple, how do you utilize personal allowance and the basic rate band? This question is often asked in your tax exam, the married couple part. So you have to know this. Okay. Each spouse are separately liable to tax. Okay. So they both might get full or partial personal allowance depending on their adjusted income. Adjusted net income, if it exists 125,140, you will not get anything. And how the spouses are using their basic rate band. That means each one of them will have 37,700 as their basic rate band. Now, how do you utilize this? First, there are 3 ways you can utilize. First way, let's say both spouses are working. Okay, one spouse is having his own business. Okay, and the other spouse does not have much taxable income. Therefore, she works as a part-time in the business. So what happens because of this? If they are taking their spouse in the business as an employee, it can save. It's a double tax saving. How? It is double tax saving from the point of both. For for the spouse who is the self-employed, for him, he can deduct any expense. Okay, he can deduct this expenses on his spouse who is now an employee as an allowable training expense of the business. But remember, the remuneration that you are giving to their spouse who is working part-time in a business has to be reasonable. It should not be excess remuneration. And the spouse is working there, the salary that is getting, the spouse, might be covered by his personal allowance. Okay, so where both spouses are participating in the business, one is self-employed, the other one is working as an employee, you can save significant amount of tax. Okay, they could be business partners or they could be shareholders and directors of a company. And also, let's say one spouse is in a higher rate or an additional rate taxpayer. This also can be minimized. How? By splitting the remuneration equally among them, so that this brings your tax down. If you're an additional rate, now you pay tax at higher rate. If you're in a higher rate, now you pay tax at basic rate, like that. Next way, an appropriate division of income generating investment among the spouses. Let's say 50-50. Okay. Now, when we are when we are tax planning for couples, most important thing is you have to take care of your nil rate band for both savings and dividend. This is what you have to think about. It's not only sufficient to look at who is higher or a lower rate spouse, also the nil rate band, because one spouse might be utilized, the other spouse might not be utilizing. Okay, so it's always beneficial to maximize. Make sure that both spouse uses their nil rate band to the maximum to bring down the tax to the lowest as a couple. Sometimes this involves transferring income from the lower income spouse to the higher earner, because lower income is anyway paying low. Okay, but the higher income is paying higher tax. If the income is, let's say, the higher earner is not able to utilize the nil rate band, what do you do? And the lower earner have some unutilized, so that unutilized nil rate band. So you cannot transfer the nil rate bands among each other, but you can transfer the income generating asset through which they earn the income. Okay, so if you transfer income from the lower income to the higher spouse, now they can use the nil rate band. And the next, so an individual is able to transfer 10% of their personal allowance. This is very important now. There is an allowance known as marriage allowance. What is it? That is 10% of your personal allowance that a spouse can transfer among each other. But remember, for this there's a condition. Both spouses has to be a basic rate taxpayer. None of them could be higher or an additional rate taxpayer. Otherwise, you can transfer. So this transfer of personal allowance is known as marriage allowance. And this transfer will be beneficial if the transferor has any unused personal allowance. Otherwise, it will not be beneficial. So how is this benefit given? Simply deduct this from your income tax liability, not your income. Once you calculate your income tax liability, from there you deduct this. Of whom? Of the transferee. Income tax liability of the transferee, from his you reduce this. Next. So for this year, 24-25 tax year, the marriage allowance is fixed at 1260. If you check the personal allowance, it is 12,570. So if you take 10% of 12,570, it's 1257. They have given a round up figure. Rather than giving 1257, they have given 1260. Okay. Remember, partial transfers are not allowed. Either you transfer 1260 or nothing at all. You can transfer less than that. Even if this creates a tax liability for the transferor, you will have some liability. Transferor will have some tax liability. You can't simply bring down the tax liability of the transfer to zero by transferring partially. Let's say the tax liability of the transfer is 300. So what is the amount that you can transfer? 300, but you can't do that. So that means at 300 you have to pay the income tax, but you can't transfer 300 because you have to transfer either 1 to 60 or nothing. So as we told earlier, the benefit to the transferee, the benefit goes to the transferee. How? From his income tax liability, he can reduce 20% of 1 to 60, that is 252. But this may be restricted. How? It might be restricted if it's necessary. Necessary, why? Because sometimes it might create a negative liability. Remember, a recipient's tax liability cannot go below zero. That's why. The moment it goes below zero, it can't. That's why sometimes it is restricted. Now, moving on to an election. Okay. So, an election to transfer the fixed amount of personal allowance. The election, you have to make an election that you want to transfer 1 to 60. How much? Up to 4 tax years after the end of the tax year. Up to 4 years after the end of the tax year. These dates are very important. One must remember it. So by 5th April 2029, okay, for the tax year, this tax year, you can make the election up to by 5th April 2029. Okay, if you are making an election within the tax year, it will continue to apply to subsequent years until you withdraw the election or the spouses are no longer eligible. Let's say they have become a higher rate taxpayer or an additional rate taxpayer. Then, or the spouses dies. So in this condition, election is withdrawn. No longer personal allowance will be transferred. Now, moving on to example 5. So example 5, there are 3 scenarios given which explains this transfer of personal allowance very nicely. Let us go through each scenario in detail. Example 5. So here we have 3 scenarios and Pat and Christian are a couple. So Pat is making an election to transfer a fixed amount of personal allowance to Christine. Okay. Now Pat has a dividend income of 500. Okay, so let me highlight this. Okay, it will not be highlighted because it's a text that I've copied in the word processor. But if it is something in the exhibits and all, then I can highlight. But anyway, I can make this bold. Dividend income. So let me make it bold. Okay, so Pat has a dividend income of 500. See, this 500 of dividend will be charged as 0% no matter what is your taxable income. Why? Because of dividend nil rate band, which is also equal to 500. So it is only the other income that will be charged. So now let us see. And for Christian, she owns a small trading business. Okay, therefore we have earned income for Pat and we have profit for Christian. Okay, at different levels under the 3 scenarios. The reasons they have given you 3 different figures is to show you the impact of the personal allowance. How the personal allowance changes from scenario to scenario. Scenario 1, 2 and 3. So under scenario 1, earned income is 10,000 and Christian's profit is 16. In scenario 2, Pat's earned income is 12, Christian profit still is 16, but earned income increased by 2. And scenario 3, earned income is less now, it's 8,000. Christian's profit is also less, 12,900. So you are supposed to what? See with the election. What is the income tax? Okay. So now let us quickly do that. Okay. So here, under scenario 1, it's 10, right? Pat's personal
allowance is 12,570. From 12,570, I can use a calculator here. Okay. From 12,570, we can deduct the fixed personal allowance that will be transferred to Kristen. That is the marriage allowance, which is 1 to 16. So for pet, this much is left, 11,310 of personal allowance is left after transferring 1 to 60 to Kristen. But if you see, pet's income is 10,000. So this 10,000 earned income is easily covered by the personal allowance of 11,310 for pet. So nothing is chargeable to income tax for pet. And coming to the dividend income for pet, this is also will be covered by the dividend nil rate ban. So that means nothing is taxable. Now, for Kristen has profit. The interesting part is in the Kristen's part because she is a transferee. Okay, so Kristen's profit is 16,000. So from this 16,000, okay, personal allowance, her own personal allowance. First we deduct that, which is 12,570. 343. Okay, then you take 20% of this. You have to get the tax. So get 20% of 3430. That is 686. So from this 686, remember 20% of 1260 is 252. 252. So from the 686 we deduct. Remember, when we are transferring personal allowance, it's a tax reducer. We deduct from the income tax. How much? 252. This is how it works. So the total profit, the total income tax liability of Kristen is 434 after the election. Okay. Now coming to scenario 2. Earned income is 12,000. See, without the election, if PAT does not make the election, if you see the earned income 12,000 from this 12, okay, we deduct 1 to 60. It's this 10,740. So without the election, if you see earned income 12,000, which is less than the personal allowance 12,570. So pet's entire earned income will be covered to his personal allowance 12,570. If he does not make the election to transfer his personal allowance, it will be covered. Also the dividend. So without the election, there is no tax liability for pet. It is 0. But with the election, just now we have checked, that is 11,310. Okay. From this personal allowance, we deduct the amount that we are going to transfer 1 to 60, which is 11,310, which we deduct from this earned income 12,000. Okay, so 12,000 minus 11,310, 690. Okay, so with election, there will be a taxable income of 690. So if you take 20% of this, it is 138. 138. So in this case, still the election is beneficial. Now, scenario 3, 8,000. Without election, it will be covered by the personal allowance. But with election, Okay, so we'll work on the Kristen's part. 12,900. Deduct her personal allowance 330. And if you take the 20% of this, it is 66. The interesting part comes now. So because this is 66 is less than 252, so your tax reduction should be up to 66. It cannot be 252 because you cannot have a negative tax liability. So now you can only reduce up to 66 because your income tax is 66. So that means your tax liability of Kristen will be 0. So this is the answer for example 5 that we have just worked out. As you can see under scenario 1, personal allowance of pet is reduced to 11,310. So it's covered by the earned income. And for Kristen's, the liability is 434 under scenario 2. Okay, without election, no tax liability, but with election there's a tax liability of 138, and still for Kristen it remains the same 252. Why? Because same profit. And under scenario 3, still there is no tax liability for pet because 8,000 will be covered by the personal allowance, but for Kristen's profit we have to do our working now. Why? Because earlier in the first 2 scenarios Kristen's profit was 16,000, so she benefited from 252 reduction of income tax. Now it's 12,900. Now she will only benefit, the reduction is restricted to 66, no longer 252, because your income tax itself is 66. That's why. So now we are moving on to gifts to charity. When you're gifting to charity, and this is for the spouses. So if a charitable donations are made either by a gift aid or a payroll giving, it is more tax beneficial for them to be made by the spouse who is liable to higher an additional rate taxpayer. That means if you are an additional rate taxpayer or a higher rate, it is advisable that you make the gift to charity so that this reduces your tax further, not for the basic rate taxpayer. Now, the next important thing on the list, high income child benefit charge. Child benefit is a payment that can be claimed by a person who is responsible for a child up to the age of 60. Okay, the benefit is payable. Remember, this benefit is payable irrespective of the recipient's level of income, but it can only be claimed by one person, not both the spouses. A tax charge was introduced in order to restrict the value of this claim so that benefit is targeted more to a lower income household. Why do they give this tax charge? So that this benefit is only given to those spouses who are lower income, who cannot support their child through their income. This is called high income child benefit charge. If you are a high income earner, there will be a charge on you for claiming child benefit. And this charge is given in your tax rates and allowance sheet in your exam, known as child benefit income tax charge. The charge is made when your net income, adjusted net income, exceeds 50,000 in the tax year and is in the receipt of child benefit. When you are receiving the child benefit in the particular tax year and in the tax year your adjusted net income is more than 50,000, then charge arises. Or you are living with a partner in receipt of a child benefit. Either you are claiming it or your partner. So the charge is made on the partner with a higher adjusted net income. If both of you are having high, the one who is having the higher. Adjusted net income is The net income less the gross amount of personal pension contribution less the gross amount of gift aid donation. Two things are deducted from net income. Pension contribution, that also personal not occupation, and gifted donations. The amount has to be gross, not the net figure. This is the same as the adjusted net income for deciding your personal allowance restrictions. So it's the same thing which is applicable here. How this is reduced? The tax charge is calculated as 1% of the child benefit received for each 200 of adjusted net income in excess of 60,000. Where adjusted net income is in excess of 80,000, remember all of the value of your child benefit will be charged if it's more than 80,000. So we'll do our working for this to understand the calculation. Liability to tax charge should be declared by self-assessment with the payment due dates and payment on account same as income tax. This works as same as income tax. So this tax charge may result in some individuals having to complete a tax return. Sometimes you might only have this, for which you have to complete a tax return. In order to simplify matter, there is an election. So there is an election that is available for person who is eligible to receive child benefit to not have it paid. Let's say you are eligible to receive the child benefit, but you do not want it. So you can make an election that you don't want it to be paid to you. In this case, this way you can save tax. You don't have to pay the child benefit charge. You can avoid it by making the election. But why would you do that? Especially where your income is more than 80,000. You see that your income is more than 80,000, it's better you make a claim to not receive the child benefit. Otherwise, the entire amount will be chargeable. Okay. Now, so partner is a much wider term than the spouse or a civil partner. And this refers to people living together as if they were married. In your exam, they will tell you. Okay. Note that the charge can and often will be made on a person other than the child benefit claim. So the charge rests with the partner who has the higher income. If there are two spouses, both are having high income, the one who is having the higher income, the charge will be on that spouse. Now this is the last question for this lecture, that is activity 11, where we have to calculate the high income child benefit charge given the following level of income of the spouses. And you have to state who bears the charge. Is it Hugo or Lucia? Okay, so Hugo and Lucia have two children under 16 and they are receiving a child benefit. Lucia is receiving the child benefit of 2213. So let's see who bears the child benefit charge. So now in A, if you see both Hugo and Lucia has income, child benefit, both has income of 60,000. So none of them have income in excess of 60,000, so no charge arises. In B, Hugo has a higher income and both have in excess of 60, but Hugo has higher than Lucia, 63. So because it's more than 60,000, this is how it's calculated. Okay, so we'll take, I will show in the Excel, equal to 63,000 minus 60,000. Okay, divide this by 200. So I will put a bracket, close this by bracket, divide by 200. It's fixed, by the way. the division of 200 and deduction of income by 60,000 and take 1% of it, and child benefit charges 2213 for this tax year. So now we'll calculate this into this into this. Done. So it is this. So it is 63,000. Sorry, 63,000. Yes. Okay. 332. Okay, I will round this figure. I'll go here. Go to custom. Put this 0. Okay. So you see, this is the charge. Coming to part C. Part C, if you see, Hugo no charge because less than 60. It is Lucia 66. So what I will do is I will just change the figure here. I will change this to 66,000 and the figure automatically changes to 664. And D. D, it's for Hugo 85,000, and it's because it is more than 80,000, the entire amount is chargeable. That is 2213. So this is the answer for activity 11, where we see which spouse has a higher income and who has to bear the charge. Now, the last part of this lecture, which is your basic income tax planning. So the tax-free investments. There are some tax-free investments where you make investments but you don't have to pay tax. And this is in addition to the basic tax planning measures for the married couples. So if you invest in ISA, individual savings account, you don't have to pay tax. Then if you are contributing into any registered personal or occupational pension scheme, there is a limit up to which your contributions are tax free. We have just covered pension in this lecture, and also we have covered charitable donations by payroll or gift aid. Again, it reduces tax. So that's it for this lecture. Now, from which part of the syllabus, which part of the syllabus did we cover in this lecture? This lecture we have touched section B of the syllabus, which is income tax and NIC. And we have covered the investment income. For example, we have calculated tax payable on savings and dividend income. Then calculation of taxable income and income tax liability. How to prepare basic income tax computation, the different types of income, then calculating personal allowance, then transferring the personal allowance among the spouse known as marriage allowance, then computing income tax payable, then qualifying the interest that you are paying for qualifying purpose that you can deduct from total income, and treatment of gift aid donations and charitable giving, child benefit tax charge. So all this we have covered here, and the treatment of property owned by the spouse. Then how do you minimize income tax? By contributing into occupational or personal pension scheme, and also by utilizing the basic rate band of the spouses or transferring personal allowance among the spouses. Then basic income tax planning. So let us summarize this lecture, the things that we have covered here. So first we started with net income. What is net income? This is from your proforma. You calculate your total income. Total income is savings, non-savings, dividend, all types of income you add, known as total income. Deduct your qualifying interest paid if you have any, and trade losses. Trade losses are deducted after qualifying interest paid. This order is very important. Then next is your taxable income.
for taxable income you need your net income, and for net income you need total income. So first is total income, then is net income, then is taxable income. Then so your taxable income is your net income less personal allowance. This personal allowance also can reduce. Okay, we have gone through the limit where your adjusted net income, if it's more than 100,000 to 125 140, personal allowance keeps reducing from 12,570. Once it reaches 125 140 and more than that, no personal allowance. Okay, and tax on earnings from employment and pension are deducted at source. That is pay as you earn, payee. This is mostly for employment income and pension, but not for self-employment income. Other incomes are collected by self-assessment. So personal allowance for this tax year is 12,570. As I told you earlier, if your adjusted net income is more than 100,000, personal allowance keeps reducing one for every two. And your adjusted net income is your net income minus gross personal pension contribution and gross gifted donation. Both has to be gross. And it will be given to you in the exam. They will give you the net figure. You have to gross it up and deduct from net income and get your ANI. Next, income tax. So income tax rates changes based on your income level and the type of income. Savings and non-savings are taxed at the same rate 40, 20, 40, 45%. But dividend income are taxed at a different rate. Okay, and for savings, we have a savings nil rate band. 1,000 for basic rate taxpayer, 500 for high rate taxpayer, 0 for additional rate taxpayer. And if first 5,000 of your taxable income is savings, that means you have no non-savings income, then that also will be taxed at 0%. That is known as the starting rate, starting 0% rate. And your interest, that is your savings income, this is received gross mostly, so you don't have to worry about it. And dividend also gross, all the gross income only you put in that column, non-savings, savings, dividend, all gross income. And dividend income, by the way, the first 500 of your dividend is always taxable at 0. This is known as dividend nil rate band. And then from your total income, okay, before you deduct personal allowance from total income, there are some reliefs that you need to deduct. They are interest on qualifying loans. Let's say you're taking a loan to purchase a partnership interest. That's a qualifying purpose. So it becomes a qualifying loan. So interest on that you can deduct from total income. And any trading loss you have to deduct from total income. Let's say you have some trading loss that is carried forward because you couldn't relieve it before. But remember, interest deduction should be done before trading loss. Then, any amount of charitable donation made under gift aid, okay, attracts tax relief. That means it saves tax. If you are a basic rate, there's a 20% relief. How? Because you are paying net, so that 20% relief is given at source. And if you are a basic rate taxpayer, the income tax computation ignores the gift because there's no relief. That relief is given at source only. But if you are a higher and additional rate taxpayer, most of the time in your exam, if you see, either you will be higher rate, either you will be an additional rate taxpayer. Here, there is a benefit. How? You extend the band. You extend the basic and the high rate band. So that extension is equal to actual amount that is paid multiplied by 180. This is known as grossing up because you are given the net figure of gift aid. Same for personal pension contribution also. And pension received are taxable. They are your earned income, like how you receive your salary on which you have to pay tax. Same for pension. You receive pension, you pay tax. So pension received are taxable as earned income except a lump sum. If you are taking a lump sum, it's not taxable. But it is only up to 25% of the fund. That is not taxable. Balance is taxable. Contribution. If you are making a contribution to an occupational scheme, they are deducted from employment income. Let's make this very clear. How will you decide? What in case if you forget which contribution to deduct from employment income? See, it's very easy. Your employment is an occupation. So occupational contribution deduct from employment income. This is how you remember. Okay. And when it's personal contribution, it is paid net of 20%. So same way how you extend the band for gifted donation, you extend the band if you are making a personal pension contribution. You gross it up. Amounts in excess of the current year annual allowances for pension. If you are making any amount in excess of current year annual allowance plus your unused allowances, which is up to 3 years on a FIFO basis, you have to pay tax on the excess. What is the current year allowance? 60,000 for this tax year. Okay. Now each spouse is a separate taxpayer. In certain circumstances, one spouse could transfer to another spouse their personal allowance, 10% of the personal allowance. What is your personal allowance? 1257, 10% of it will be 1257, but they have taken a round figure. Therefore, that's how you get 1260. And if you take 20% of that, it's 252. So that means you can read the transferee can reduce their tax up to 252. Okay, by 252. It's the max. Charitable donation should be made by the spouse who are subject to high rate tax, because then they can reduce their tax further. And high income child benefit charge. There's a high income child benefit charge. If you are a high income earner and if you are claiming child benefit, there is a charge to it. So a partner who has is just a net income more than 60,000, there's a charge. And we have just seen in the question how did we work out on the charge and who actually bears the charge. The one who has the highest income of the spouse. Now, so what are the technical articles one must read from this for this lecture? There is no technical article for the Finance Act 2024. Now, thank you for watching and I shall see you in lecture 3. So, my first 2 lectures are out on my YouTube itself under the tax playlist. You can watch out. And do not forget to subscribe to my channel if you haven't subscribed. Thank you.